Hey everyone, welcome back to the channel. Today we're diving into one of the most common questions I get from new and sometimes not so new business owners. And that is, how do I pay myself from my LLC? Whether you're a freelancer, an entrepreneur, you have a side hustle, understanding how to legally and efficiently take money out of your LLC is really important, not just for your wallet, but for taxes too. So don't go anywhere, because by the end of this video, you'll know exactly how to pay yourself the right way from your LLC. The first thing you need to know is, what type of LLC do you have in the eyes of the IRS? Even though you may have formed a limited liability company with your state, the IRS doesn't recognize LLC as a tax classification. They treat your LLC based on how many owners it has and what election you've made. Here are the main options. You have the Single-Member LLC, which by default, you're treated as a disregarded entity. The IRS sees you as a sole proprietor, it doesn't see the LLC. You also have the Multi-Member LLC, which by default is considered and treated as a partnership. The LLC can also elect to be taxed as an S-Corp or a C-Corp, and that is done by filing Form 2553 or 8832, and it must be accepted. So depending on which you are a member of affects how you pay yourself. So let's break that down. If you're a single-member LLC, there's no employees, it's just you. Your LLC is called a disregarded entity. This basically means that your entity is, well, disregarded. The LLC itself doesn't matter, or the LLC doesn't have its own tax identity or obligation, but rather the IRS looks to the sole owner or member to declare the activity. If the member is a person or an individual, it will treat you like a sole proprietor. That means that you don't pay yourself a salary. Instead, you're gonna take an owner draw. Why is that? Because at the end of the day, when you declare the LLC's income and expenses, you do it on your own personal taxes. It goes on Schedule C, the same place that you declare any 1099 that you receive. You pay income tax and self-employment tax on all of the profit. So what does that mean? You transfer money from your business bank account to your personal bank account, and that's it. No payroll, no W-2, just a transfer. You pay yourself whatever you need to, keeping in mind that you don't deplete the business account. You should, however, make sure that you, number one, keep good records of those draws. Number two, you should have separate business and personal bank accounts. You should not treat the business account as your own personal account. Number three, you should save money for taxes, because even though it's not a paycheck, you still owe income tax and self-employment tax on your net profit. So let's say you're a single-member LLC and your business makes $80,000 in profit after your expenses this year. You decide to pay yourself $4,000 per month as an owner's draw. That money is not deductible as an expense for the business. It's just a distribution of the profit. When tax time comes, you're going to report the full $80,000 on your Schedule C, and you'll owe income tax and self-employment taxes on the $80,000, even if you only took out $48,000 in actual draws. But that's why it's important to track both your business income and your draws. Now, let's say your LLC has multiple members. The IRS treats it as a partnership by default. Important to note that you still don't take a salary. Instead, each member takes an owner's draw based on their percentage of ownership. You have to keep that percentage of ownership in mind. At tax time, the LLC is going to file Form 1065, and each member gets a Schedule K1 showing their share of the profit or the loss. Again, taxes are due on your share of the profit, whether or not you actually took the money out. Now, partnerships can get tricky because you need to keep in mind what each member gets paid or draws. It's supposed to be based on the profits and their basis in the company. You may pay yourself and the other member or members throughout the year, assuming that the business will turn a profit, but it may not. So I mentioned the word basis. You may be wondering what that is. A member's basis is their ownership interest in the LLC. Okay, so think of it like your tax cost in the LLC. It starts with your initial contribution, and that could be cash, it could be property or services. It's then adjusted each year for increases or decreases. Now, increases are any additional contribution that you've made, the share of the LLC's income, and share of the LLC debt if it's taxed as a partnership. What can be considered a decrease? Decreases are distributions you've received, your share of the losses, and non-deductible expenses. So why is basis important? because if there is a loss, you can only deduct your share of the LLC loss up to your basis. So if your basis is, say, $5,000 and the LLC passes you a $7,000 loss, you can only deduct up to $5,000 of that loss because that was your basis. Distributions are not taxable if they don't exceed your basis. If you take out more than your basis, the excess is a taxable gain. Basis is used also to calculate whether you have a capital gain or loss when and if you sell your LLC interest. So let's look at an example and see this with numbers. Let's say you invest $10,000 in an LLC. In year number 1, you get a $3,000 of income. The basis increases then to $13,000. You then take a $2,000 distribution, so the basis drops to $11,000. In year 2, the LLC has a $4,000 loss. So that means the basis is going to drop to $7,000. If you try to deduct more than that $7,000 in losses in future years, the IRS won't allow it unless your basis increased. There are times when, besides splitting the profits, a member gets paid a salary to do a certain function in the business. These are called guaranteed payments, and I'm not going to get into the weeds on this video, but the bottom line is that members of a partnership should not be on payroll unless there is a stipulation that someone will get guaranteed payments. Now, here's where things get a little more structured. If your LLC elected to be taxed as an S or a C-Corp by filing Forms 2553 or 8832, the rules change. In this scenario, you must pay yourself a reasonable compensation as an employee of that business if you're an active member. This means that you are going to run payroll. You pay yourself through W-2 wages, you withhold payroll taxes, and you're going to file quarterly payroll reports. But you can also take distributions of profit on top of your salary, and those distributions are not subject to self-employment tax, just regular income tax. So why do people do this? Why do they elect S-Corp? To potentially save money on self-employment taxes, but it comes with more paperwork and payroll obligations. So talk to a tax pro before switching to an S-Corp. The S-Corp is a great tax saving strategy, but it is not designed to help you evade taxes. Two totally different topics. Active officers in an S-Corp must have reasonable compensation paid via payroll throughout the year. This is a high-risk area that gets a lot of people audited frequently. So you have been warned. Please pay attention to this topic. No matter how your LLC is taxed, here are a few of the golden rules. Number 1, keep your business and personal finances separate. You can open a separate business bank account or several bank accounts. You should use accounting software or spreadsheets to track everything. Number 2, don't take more money than your business can afford. In other words, always leave enough money in there for taxes and operating expenses. You don't want to deplete the account. Number 3, pay yourself consistently. Whether that's weekly pay, bi-weekly, monthly, set a schedule so you're not constantly guessing. Number 4, make a plan for your taxes. Don't ignore them because they are coming. Set aside 25 to 30% of your net profit for your taxes if you're self-employed. Consider paying quarterly estimated payments throughout the year to help you stay ahead of the game and not get such a hit come tax time. So let's wrap it up with some quick don'ts. Don't pay yourself under the table. Keep records and use your bank account. Don't commingle funds. This is a big one. Avoid mixing personal and business expenses. Your business is a separate entity from you. Please don't get that mixed up. Don't forget your taxes. Just because you're not getting an actual paycheck doesn't mean the IRS isn't expecting their cut. Don't guess your salary if you're an S-Corp. Use industry benchmarks or consult a professional. To wrap it up, paying yourself from your LLC isn't complicated, but it does depend on how your business is taxed, whether it's a simple owner's draw or a structured salary. Following the rules keeps your business healthy and the IRS happy. If this helped you, give it a like, subscribe for more tips, and let me know in the comments how you pay yourself from your LLC. And if you want a video on LLC versus S-Corp or estimated taxes, let me know. We'll go ahead and try our best to make that for you. Thanks for watching, and I'll see you next time.